Imagine you have $10,000 to invest. What would happen if you put it into the three best Fidelity index funds? In this video, we explore two radically different strategies using the same funds. One approach aims for steady income, while the other chases explosive growth. Our case study follows John, a hypothetical investor, as he constructs two portfolios from the same starting point. The results are surprising and offer valuable lessons for anyone considering index fund investing. Let's dive in and see how the choices you make can shape your financial future. Fidelity index funds are baskets of stocks that follow specific rules, automatically tracking an index without an active manager picking winners. This means lower fees and consistent performance over time. John chose three funds to cover all essential portfolio needs: income, growth, and international exposure. These funds are designed to work together, providing a balanced approach to investing. Understanding how these funds operate is crucial before diving into the strategy. Let's break down each fund and its unique role. The first fund, FDVV, is the Fidelity High Dividend ETF. It focuses on large and mid-cap U.S. companies that pay high dividends and are expected to grow them over time. Surprisingly, its top holdings include tech giants like Nvidia, Apple, Microsoft, and Broadcom. These companies' massive profits have translated into substantial dividend payouts. FDVV offers a 2.8% dividend yield, a 10.85% 5-year dividend growth rate, and 9.16% annual price appreciation. This fund is chosen for its ability to generate reliable income, making it a cornerstone for income-focused portfolios. Next up is FNCMX, the Fidelity Nasdaq Composite Index Fund. This fund tracks the entire Nasdaq composite, which includes around 3,000 companies. It's heavily weighted toward technology and innovation, with top holdings like Apple, Microsoft, Nvidia, Amazon, and Meta. FNCMX is picked strictly for its maximum growth potential. Its numbers are impressive: a 0.48% dividend yield, a 6.91% 5-year dividend growth rate, and a whopping 17.45% annual price appreciation. This fund is ideal for investors who want their money to grow rapidly. The third fund, FTIHX, is the Fidelity Total International Index Fund. It provides exposure to over 5,000 stocks outside the U.S., covering both developed and emerging markets. Top holdings include Taiwan Semiconductor, Nestle, Novo Nordisk, and ASML. FTIHX boasts the highest dividend growth rate among the three funds, making it a powerful engine for compounding income. Its stats: 2.54% dividend yield, 16.98% 5-year dividend growth rate, and 6.2% annual price appreciation. This fund is crucial for adding global diversification to any portfolio. John's first strategy is the dividend-tilted portfolio, designed to maximize sustainable income over time. The weights are 50% FTIHX, 30% FDVV, and 20% FNCMX. Why so much in the international fund? FTIHX's high dividend growth rate compounds income fastest over decades. Even with this weighting, the U.S. side still makes up half the portfolio. This approach is all about creating a steady, reliable income stream that grows over time, without needing to sell shares. Dividend portfolio averages a 2.2% blended yield, 13.13% blended dividend growth, and 9.14% annual appreciation. These numbers reflect a balanced approach that prioritizes income while still allowing for growth. Over time, the reinvestment of dividends creates a snowball effect, compounding returns and increasing the monthly payout. This strategy is ideal for those who want predictable cash flow and capital preservation. In the first year, the dividend portfolio grows to $11,134. It's a modest start, but the foundation is set for future growth. The initial gains may seem small, but the power of compounding is just beginning. This stage is crucial for building momentum and establishing a reliable income stream. Investors must be patient and trust the process, knowing that the real benefits will come with time. At year 10, the portfolio has grown to $30,453. The snowball effect is now visible, as reinvested dividends and appreciation accelerate the growth. The income stream is becoming more substantial, and the compounding process is in full swing. This stage demonstrates the importance of staying invested and allowing time to work its magic. The portfolio is on track to deliver increasing monthly income. At year 20, the portfolio reaches $103,773. The compounding effect is now undeniable, with reinvested dividends significantly boosting the account value. The income generated is substantial, and the portfolio continues to grow without the need to sell shares. This stage highlights the power of long-term investing and the benefits of a dividend-focused strategy. After 30 years, the dividend portfolio is worth $416,613 and pays $2,048 every month, or $24,577 per year, for life. Of the total growth, $255,067 comes from capital appreciation, while $151,546, nearly 37%, is purely from dividend reinvestment. The investor never has to sell a single share to generate their monthly income. This is the ultimate goal for those seeking financial independence and security. The income breakdown in year 30 shows that $255,067 comes from capital appreciation, while $151,546 is from dividend reinvestment. Nearly 37% of the portfolio's growth is purely from dividends. This means the investor enjoys a steady monthly payout without ever touching the principal. The strategy is designed for those who value stability and want their investments to work for them, not the other way around. Second strategy flips the script, focusing on maximizing the final account balance. The weights are 70% FNCMX, 20% FDVV, and 10% FTIHX. FNCMX dominate because its historical appreciation dwarfs the other funds. Dividends and international diversification become minor hedges rather than core engines. This approach is for those who want to see their net worth soar, even if it means sacrificing steady income. The growth portfolio averages a 1.15% blended yield, 8.71% blended dividend growth, and 14.67% annual appreciation. These numbers reflect a strategy that prioritizes share price appreciation over income. The focus is on building wealth, with dividends playing a much smaller role. This approach is ideal for those who are comfortable with asset liquidation and want to maximize their total net worth. In the first year, the growth portfolio grows to $11,582, showing a slight edge over the income-focused approach. The initial gains are modest, but the foundation is set for exponential growth. Investors choosing this strategy must be patient and prepared for the long haul, as the real benefits come with time and compounding. By year 10, the growth portfolio has reached $42,454. The gap between the two strategies begins to widen as share price appreciation accelerates. The portfolio's value is growing rapidly, but the income generated remains minimal. This stage is ideal for those who prioritize net worth over cash flow. At year 20, the growth portfolio hits $173,989. Massive exponential growth kicks in, driven by FNCMX's high appreciation rate. The portfolio's value is soaring, but the monthly income remains low. This approach is best suited for investors who are comfortable with asset liquidation and want to maximize their wealth. After 30 years, the growth portfolio is worth $699,558. This is a massive balance, but it pays only $98 per month in dividends. Almost 98% of the growth comes from share price appreciation, with minimal dividends to reinvest. This is wealth on paper, but it requires selling shares to generate income. The breakdown in year 30 shows that almost 98%, $675,422 of the growth comes from share price appreciation. Because the funds pay minimal dividends, there is virtually nothing to reinvest. This strategy is all about building wealth, but it comes with the challenge of needing to sell shares to fund your lifestyle. It's a high-risk, high-reward approach. A mathematically savvy observer might note that applying the standard 4% safe withdrawal rule to the $699,558 growth portfolio yields about $27,982 a year, or $2,332 per month. This technically beats the dividend portfolio's $2,048 per month. However, theory and practice diverge drastically here. The 4% rule assumes you can safely withdraw a fixed percentage each year, but it doesn't account for market volatility or sequence of returns risk. In the dividend portfolio, the investor does not sell anything. The $2,048 per month comes strictly from cash dividends. The principal remains completely untouched and invested. This provides peace of mind and financial security, as the investor is not exposed to the risks of selling shares during market downturns. The strategy is designed for those who want a self-sustaining cash machine. Get $2,332 per month from the growth portfolio. The investor must actively sell shares. If the market crashes the year they retire, they are forced to sell shares at a loss to fund their lifestyle, a phenomenon known as sequence of returns risk. This is the primary reason retirees with massive accounts can still run out of money. The strategy requires careful planning and risk management. Sequence of returns risk refers to the danger of having to sell assets during a market downturn. If you retire and the market crashes, you may be forced to sell shares at a loss, which can quickly erode your portfolio. This risk is especially relevant for growth-focused strategies that rely on asset liquidation for income. Understanding this risk is crucial for anyone planning their retirement withdrawals. Ultimately, neither portfolio is intrinsically wrong. They represent two very different bets. One prioritizes a self-sustaining cash machine with absolute capital preservation, while the other maximizes total net worth at the cost of requiring systematic asset liquidation. The choice depends on your financial goals, risk tolerance, and retirement plans. When deciding between income and growth, consider your personal goals. Do you want a steady monthly payout without selling shares, or are you comfortable with asset liquidation to maximize your net worth? Each approach has its advantages and drawbacks, and the best choice depends on your unique situation. Risk management is essential, especially for growth-focused portfolios. Market downturns can impact your ability to withdraw funds safely. Diversification, careful planning, and understanding sequence of returns risk are key to protecting your investments. Always consider the risks before making major financial decisions. Compounding is the secret sauce behind both strategies. Reinvested dividends and appreciation work together to grow your portfolio over time. The longer you stay invested, the greater the benefits. Patience and discipline are crucial for maximizing returns and achieving your financial goals. Adding international exposure through FTIHX provides diversification and reduces risk. Global markets offer opportunities for growth and income and help balance your portfolio. Diversification is a key principle for long-term investing success. Dividend growth rates are crucial for income-focused strategies. FTIHX's 16.98% rate compounds income faster than the other funds. High dividend growth means your monthly payout increases over time, providing inflation protection and greater financial security. Share price appreciation is the main driver for growth-focused portfolios. FNCMX's 17.45% annual appreciation is impressive, but it comes with volatility. Investors must be comfortable with market ups and downs and be prepared to sell shares when needed. Blended metrics help you understand the overall performance of your portfolio. The dividend portfolio averages 2.2% yield, 13.13% dividend growth, and 9.14% appreciation. The growth portfolio averages 1.15% yield, 8.71% dividend growth, and 14.67% appreciation. These numbers guide your decision-making and highlight the trade-offs between income and growth. Reinvesting dividends is key to compounding returns. Over time, reinvested dividends create a snowball effect, accelerating growth and increasing your monthly payout. This principle is at the heart of income-focused strategies and is essential for maximizing long-term returns. Growth-focused portfolios require asset liquidation to generate income. Selling shares exposes you to market risk and sequence of returns risk. It's important to plan withdrawals carefully and understand the potential downsides of this approach. Income-focused portfolios prioritize capital preservation. The principle remains untouched, and income is generated from dividends. This approach offers stability and peace of mind, especially during market downturns. Growth-focused portfolios build wealth on paper, but require selling assets to realize gains. This can be risky during market downturns and may lead to running out of money if not managed carefully. Understanding the difference between paper wealth and real income is crucial. Dividend growth provides inflation protection. As dividends increase, your monthly payout keeps pace with rising costs. This is a major advantage for income-focused portfolios, ensuring your purchasing power is maintained over time. Market volatility affects both strategies, but impacts growth-focused portfolios more. Selling shares during downturns can erode your portfolio quickly. Income-focused portfolios are more resilient, as dividends provide steady cash flow regardless of market conditions. Choosing the right portfolio is crucial for retirement planning. Income-focused strategies offer stability and predictable payouts, while growth-focused strategies maximize net worth but require careful withdrawal planning. Consider your retirement goals and risk tolerance before making a decision. Regular portfolio rebalancing helps maintain your desired asset allocation. Adjusting weights between income, growth, and international funds ensures your portfolio stays aligned with your goals. Rebalancing is a key part of disciplined investing. A long-term perspective is essential for both strategies. Staying invested and allowing compounding to work over decades is the best way to achieve financial independence. Short-term fluctuations are less important than long-term growth and income. Fidelity Index funds offer low fees, automatic tracking, and balanced exposure to income, growth, and international markets. Choosing the right mix depends on your goals and risk tolerance. Both strategies have their merits, and understanding the differences is key to making informed decisions. John's $10,000 investment demonstrates the power of strategic portfolio construction. The dividend portfolio delivers steady income and capital preservation, while the growth portfolio maximizes net worth but requires asset liquidation. The choice is yours, and understanding the trade-offs is essential for success. When choosing between income and growth, reflect on your financial goals, risk tolerance, and retirement plans. Both strategies offer unique benefits, and the best choice depends on your personal situation. Take time to evaluate your options and make an informed decision. The $10,000 portfolio case study shows how the same funds can produce vastly different outcomes depending on your strategy. Whether you prioritize income or growth, understanding the mechanics of each approach is crucial. Stay disciplined, manage risk, and invest for the long term to achieve your financial goals. In summary, the $10,000 portfolio strategy offers two distinct paths: a self-sustaining income machine or a wealth-maximizing growth engine. Both have their strengths and weaknesses. The key is to align your investment choices with your personal goals and risk tolerance. Fidelity Index funds provide the tools. It's up to you to choose the right mix for your future.